Brooklyn, just for the recording. But yeah, so when it comes to quoting people, the main thing is always ask the questions. Don't go right into it. One, never talk about rate, something I always talk about, unless if someone asks, but it doesn't really matter, and it's not going to help them equate it. And especially in all three of the areas you all who are on the call are looking to work in, you can always lean more on appreciation over where interest rates are at. So if and what I would tell buyers is, hey, listen, they're like, where are interest rates at? Well, interest rates are kind of high, but at the same time, your monthly payment's where you want it in the price range you're looking. Here's how I'll show you. And you pull up Arrive, you show them on a Zoom, and you say, look, I get that you're hearing this interest rate. Now, here's the good thing for you is everyone else is hearing the same interest rate, if not higher. I mean, we cut our costs down really low, and so we work with the cheapest lenders, who have the best rates. So you're getting some of the best rates. That means that there's significantly less competition. Now, what do you think is going to happen when rates drop with competition? It's going to go up. They say that if it drops 0.5%, I know we talk about 50 basis points, but if it drops 0.5%, so it goes from 7 to 6.5, you open up a bigger buyer pool. If it's at 7, your buyer pool, your competition is this. When it gets to 6.5, 6, 5.5, 5, and it just grows exponentially, and that's when your value is going to go up. You're looking at buying a property in an area with great appreciation, and we have an appreciation and amortization, or a calculator. All it does is add on appreciation over 5 years. That's why you want to ask, hey, how long do you plan on being in this house? How long do you plan on keeping it? You said 5 to 7 years. Okay, well, in 7 years, and I always pull up our Excel, it's like the most basic thing. It just has our logo at the top. In 7 years, this is going to be your value. People in other states complain about Californians coming in and paying cash. Well, that's why, because we have good appreciation in your area. And I just always look it up based on the area. You're looking in Denver, Colorado. Hey, Denver, Colorado, over a 10-year spread has average appreciation of this. So this is why it'd be a good idea to buy now versus waiting. Then you can always get into, hey, but if you're looking at a place that doesn't have offers, always call me and let's talk about some options, because there's ways that we can get your monthly payment in a better position for you to feel more comfortable when you're purchasing. Because there's 1.0 buy downs, there's 2.1 buy downs. Basically, they can buy down their rate for a couple of years, expecting that rates will drop. Those are always great. In an initial call, even a second initial call, you don't really want to talk about it too much, because people it's going to go way over their head, because it's too many details about, you're talking about a temporary rate buy down versus a permanent rate buy down. And now they're like, wait, I'm just trying to understand. I thought you just get quoted an interest rate. And it's no, hey, so what I'd like to do is on a third call, or when they're looking at a house, I'll pull it up. And so I'll share my screen real quick. This is going to be the loan product that we're going to talk about today, but this is but same thing. If I were to, you can't do this with well, some lenders will allow this with DSCR, but not really. But if I'm looking at this with a client and I say, hey, listen, the par rate is that, this is for an investor loan, so don't worry, this is not actually where rates are at. This is the par rate, which means it's the closest to a zero cost or too much money back at closing. So you see how this number's in parentheses at 8.375. That's because you're getting $1,529.60 back. At 672, that's a cost to you. So when you do so that would be the par rate. Now, a 1.0 buy down is for the first full year, you get to enjoy a payment at 7.25%. Instead of 8.25. You qualify off the payment at 8.25, so $4,800 a month, but you get to enjoy 43, so that's about, around $500, a little less than $500 a month in savings, which is huge. Now, here's the benefit of the temporary rate buy down. If I were to permanently buy down the interest rate, I would be spending $21,000, which they're not going to let you do this, $21,459 to get 7.25. When I spend that much money and rates drop to 7.25, that money's gone. It's a cost to get that interest rate for that investor. I'm not talking about UWM, the investor that they're going to sell this loan to. So that cost is gone. With a temporary rate buy down, it usually is about 1.2, a little, we have a calculator for it, is the cost for a 1.0 buy down. So that would mean that it would be, if this is an $800,000 or $640,000 loan, it'd be roughly, $6,700, let's say. That would be the cost. Now, if I refinance before that year is up, they prorate it and apply it to my principal balance or towards the closing cost. So it's at least I get some money back. And if anyone's interested in, if they're big into investing in stocks, it's hedging your bet, right? So if I'm looking at a house and it hasn't sold, I'm trying to save money per month because maybe I want to put some work into the property, I think you should absolutely do that. But I think you should ask for a huge credit from the seller to pay for that temporary rate buy down. You could do a 2-1 buy down. So you go down to, well, they don't have it as an option on this one, but 6.25 for your first full year. Your second year, so in the next 12 months, it goes to 7.25 and then back to 8.25. People were selling those loans a lot in 2022. And, to me, it was, hey, the problem with that is you guys are really anticipating that rates are going to drop, but there's no economic policies that have changed. And so there was no insight to say, hey, the market is going to change. I do think enough has been enough, and there's enough pressure on politics that something's going to happen. Inflation's going to go down at some point, possibly. So it'd be better to at least bet that. The cool thing for you is that it locks in a refinance, right? I can call people and say, hey, look, your 7 months is up, your 6 months is up, whatever it is. Now's a great time to refinance. Rates have dropped. It's a good time to apply that temporary rate buy down in principle, and then you can kind of do the math. But when you're reviewing this after you just explained the difference between conventional and FHA to a person, you're going to lose them every time. And I've done it so many times. Don't worry about temporary rate buy downs on the first call, the second call, wait till the third, or wait until they've seen some houses. And then they get an idea, okay, you saw that house, you anticipate spending about $20,000 in upgrades. Wouldn't you rather, instead of spending $4,800 a month, be spending $3,900 and save yourself $1,000 a month, at least for the first year? That's $12,000 in savings that can go towards the house. And they go, yes, now I can justify purchasing that house that needs some work. That's how you sell the temporary rate buy downs. That's how you talk about it to your to the agents that you're working with. The main thing is you have to remind them, if you're going to ask for that big of a credit, it's got to be on a house that doesn't have 20 offers. It's got to be on a house with no offers. It's been on the market for a couple of weeks. They're kind of sweating. I mean, now's a good time for stuff like that because we're going into the holiday season and a lot of people aren't looking to buy, but there are still people looking to sell. Do you on the call have any questions about that? Yeah.
What's the most that you've, how do I say this? What's the most that you've had to, not you directly, but the lender charged for a temporary buy down? What's the most that you've seen?
It's a calculation, so it's not necessarily what they charge. It's just a calculation. It usually comes out on a 2-1. It's about 2.2%. But it has to do with FICO score and a couple other things sometimes, but usually it's not.
That's the most you've seen people are willing to pay is 2.21%.
Oh, willing to pay?
Yeah.
Well, there's 3-2-1 buy downs. There's 2-1 buy downs. Let me see, where are the temporary rate buy down options? I'm not seeing it as a. Oh well. I think it's because I chose an investment property. Yeah, there's 3-2-1s, 2-1s. I would say a 2-1 buy down because it's 2.2%. I mean, you figure if it's a $500,000 house, it's a little over 10,000. I mean, it's a decent ask, but you figure most people, when they do price reductions on their listings, it's around 10,000. So
okay,
rather than, if I drop the purchase price for most people, if I drop unless if they're putting 30-40% down, me dropping the purchase price 10,000 doesn't do anything. it changes the monthly payment by, you figure 10,000 on 8.25 is going to be around $80 a month in price difference. So this is an investor loan, so this is going to be totally different, but most will be in the sixes. So you're talking about a $60 a month savings. But if you do the math, I mean, that takes a long time to save up enough to make up that 10,000. I'd rather get it as a credit and
Right.
either lower my closing costs or use it for a temporary rate buy down.
Mm-hmm. Okay.
Yeah. Yeah. Now this, to go into, the loan product that we talked about today, this is called a DSCR loan, so a debt service coverage ratio loan. This is what investors would use to buy a property without having to qualify off their own income. It's a great loan. It's a great option. It's crazy how many people have no idea about it. It's a good program. I will sit and I will look up on LoopNet and on Zillow. You figure Zillow is always going to pull data from any MLS. So any realtor, like residential real estate agent, has access to an MLS. Commercial lenders use a system called CoStar, which owns LoopNet, BizBuySell. They own all the investor business websites. So those are the two different types of agents that you have. Commercial agents are very different than residential. The license is the same, but commercial agents are not realtors, right? They don't join an association. Sometimes they join their own weird one. But the main thing is you're going to have a pool there and you're going to have a pool over here. Both are great when it comes to, duplexes, triplexes, quadplexes. You can reach out to them and say, hey, I see you have a listing. It's got a great capitalization rate. I don't know if it's still on the market. I have great DSCR loans. I'd love to talk to you about them as an option. If you have any buyers who ever express interest, because this is where you can say, hey, you get an attorney, you get someone who's a business owner who's killing it, but they have a ton of tax deductions and they need to lower their debt liability, let's say, but they want to buy an investment property. This is where they can come in and they can qualify off the income the property is producing. So they don't have to provide any of their own income documents, as long as the ratio matches up. But they come in, it's always going to be at least 20% down. Ideally, you're going to want a prepayment penalty on it, and I'll explain why. So the nuances for you as a lender is you have to know that, hey, if I don't charge a prepayment penalty, the interest rate's going to be super high. There's reasons for that. We don't need to get into it. If it's you as a lender, if it's over 5 units, it doesn't become residential. And so UWM and some other lenders probably can't do it, which is fine. We've got lenders who focus specifically on investor type loans. It becomes a commercial loan. So 5 units and above. We have lenders that can do it up to $10 million loan amounts. This is where you can change your compensation a little bit because it's a totally different loan product. If it's 2 units, up to 2 units, you can do down payment assistance programs on 2 units. So a duplex or 2 houses on 1 lot is the way I like to explain it. 3 units and above, no. But they can do owner occupied, so not DSCR, but owner occupied. Now, the thing with the debt service coverage ratio is you're using the income the property is producing in order to help you qualify. You can still use the income the property is producing on a duplex if you're going to live in one side, but you probably have to use some of your own income. Same thing with triplex, same thing with quadplex. So there are some people who are savvy and are okay living in 1 unit for a quadplex, but they want to use some of the income the property's producing. That's great. You can do that. There's not a lot of people who are willing to do that, but there might be some. So for a debt service coverage ratio, this is specifically looking at it from an investor loan. So when you select it, you have to select that it's an investment property, not owner occupied. Credit score, you're going to have decent credit. Once again, 20% down. I like to do 1 year prepayment penalty rather than 2. The way I look at it is it's going to be roughly about 1% of the loan amount as a penalty if they were to refinance before that year is up. To me, if rates really dropped and I had to spend $6,400 as a cost to save $1,000 a month, I think it'd be worth it. 700 a month, because you're looking at, hey, if rates really dropped, it could save me a lot because these are bigger purchases. When you do a 2-year prepayment penalty, and that's 2% of the loan amount, it starts to become a bigger expense than it's worth to me. But you can always present 2 options, because if you don't, someone else will, and you never know how they're going to pitch it to a point where your client, it just sounds appealing to them. So I do 1-year prepayment penalty. The debt service coverage ratio is good to do 1.25%. So here, as a lender, and when you're kind of explaining it to your client or the real estate agent, you have to explain that it's gross rent, not net rent, that they're going to look at. But it's gross rent divided by principal, interest, taxes, insurance, and some lenders will add an H, so PITIH, so homeowners insurance. So if this is a condo or in an HOA, it's homeowners association, not homeowners insurance, homeowners association fee on top of that. So it's any fee related to the property. That is what they're going to count against, in the PITIH, divided by the gross monthly rent. Or sometimes they'll say add it all up in 12 months. It's the same thing. It's going to be the same ratio. So when I look at a property, sometimes they advertise a capitalization rate, which is a good reflection of, so basically the way it should be is net operating income divided by the purchase price, or vice versa. You can look it up. It's super easy to figure out. That's how they come up with capitalization rate. A lot of times when people are advertising properties, they're going to go off of gross rent, which is fine because it depends what someone's goal is. Now, remember, the main thing whenever you're talking to any client is, what are their goals with the property? Ask questions. Do not sit there and talk about things that are irrelevant to them. Some people want a buy and hold method. They say, hey, I want to buy investment properties because I am totally sold already on the idea of, 1, I get to take a full depreciation on the asset, so I get to lower my tax basis for this year. And 2, I'm just waiting for the value to shoot up over time. So I don't need to talk to them about, trying to make this a cash flowing deal or not. Other people, they want cash flow right now. So listen to what their goals are and then go based off of that. Some people, they want to put 20%. Some people are fine putting 30%. And they just tell you straight up, hey, I want to put 30% down on a place. Don't push it. You can always offer them the option of doing 20%, right? But sometimes I don't think why do 30% if you don't have to? Put that money into the property. Present it as an option, but listen to what they said and just go with that's what their goal is. Right. So when I pick that and I go and I see, okay, the par rate is 8. I like to do borrower paid, and I do charge usually when I do a bigger loan amount, I do 1% as my commission. So you can either factor that into the interest rate, and I can say, okay, 8.75, or they can pay it as a cost. Most investors are okay paying it as a cost. So if it was 1% of the loan amount, $6,400 as a cost. The nice thing with UWM is I can still apply my basis points. So I know some of you who are on the call right now are kind of new. UWM, we get up to 40 basis points that we can apply per loan as our partner points when we do certain things, and we always help you get these points. So you're going to end up getting 40 basis points. So really, I'm only charging 0.6% of the loan amount. So it's really not like I can always win these over because most people will charge more than that. But what I look at it is I say, as you're right. So there's things I have to understand on my side. Now, when I'm explaining this and selling this to a client, I'm just talking about, hey, listen, there's 3 main things. 1, you get to lower your tax liability because you're buying another investment property with more tax deductions. 2, values will keep going up if you keep raising rent. And as long as you find good property managers or you do a good job managing it, your value is going to really shoot up, and this is going to be a great asset. Depending on the area, I mean, most areas in California and Colorado, Arizona, there aren't a lot of multifamily properties getting built. It's just, for some reason, it's really hard to build them. And then Third is there are great deals out there that people miss. The reason why I like to say that third one is because all the time I hear people say, oh, I'd love to buy a duplex or a triplex or this. Like I had someone recently, hey, I own 2 duplexes, 3 quadplexes. I just cannot seem to find a deal over 6 units. I'm like, okay. And like, I really want to get in that space. And I go, why can't you find a deal? And they're like, there's none out there. I said, how do you find your deals, right? Keep asking the questions. How do you find the deals? And they go, I kind of look on Zillow and stuff like, boom, I hear Zillow. There's no residential real estate agent who's working a lot on Zillow. They're going to be on LoopNet. And so I go and I find those deals for them and say, hey, look, what I look at is if they're advertising a cap rate or I calculate it, and it's if this is the interest rate that I'm quoting and the cap rate's at 9%, there's probably a good chance that this is going to work for the 1.25 ratio, right? If the cap rate's a little over. It's going to be a little different, right? When someone's putting 30% down, I know I'm talking about a lot of details. You kind of have to hear these loans a couple times. But if someone's putting 30% down, that cap rate's going to seem a lot better. That ratio is going to get a lot better. And so you have to talk to them about, what are their goals? Are you wanting something that's cash flowing? Because sometimes I get people who say, well, I want a 9% cap rate. Okay. Does that mean you want something cash flowing right now? Like what else are you looking for? Because that'll tell you a lot. Some people just watched Bigger Pockets podcasts, for those of you who have ever heard of that, and they just hear, oh, I'm supposed to look at this cap rate. Well, even they say, well, it depends, like what's the upside potential? What's this? So there's a lot more to look at, and that's why you want to talk about their goals more. Otherwise, you're just going to tell them, sorry, there's nothing on the market. The interest rate's 8.25. I don't really go over interest rates. I hear what they say, and I say, let me go and shop around different lenders and figure out the best option for you. With these specific loans, that's when I like to come back with them and say, hey, I found these 2 properties. Now with this loan, here's where the interest rate is at. Here's where the payment's at. This is not including taxes and insurance. So I'd kind of calculate that and add it in. And I'd say, this is why this property would be a good deal. Because if I look at it, it's a 1.25 ratio, which means you're cash flow positive. Sure, we can look at it from a cap rate of this, but here's why there's also this potential, right? I try to sell it. I know that might be the realtor's job, but with these types of deals, the realtor totally misses the ball on that more often than not. If you find a good real estate agent, that's where you can go and who understands these types of deals and say, hey, look, this is where interest rates are at. Can you help me find a good property so I can pitch it and sell it, right? That is where I would start to work with the good commercial real estate agents, and I would call them and say, hey, I really understand DSCR loans. Even if you don't fully understand it, it doesn't matter because everyone's situation is totally different. Some people want to put a ton of money down, and so you understanding the bare minimum isn't relevant to some of the very savvy investors. So I just say, I call the agents and I say, I'm looking for a agent who gets a lot of multifamily listings or wants to work with investors, because I'd love to be a partner with you to help you close more of these deals. They say, well, how so? Well, I would love to get a client. They tell me their situation, what they're looking for. I would like to get them a quote on the back end, but before I tell them, I want to be prepared with a property that matches what their goals are. So then I'm going to come to you and I'd like to talk with you about, hey, this is what we need to look for and see if you can find any. And if you find one, then we can sell them right then and there on that property. I'll go sell them on the property with you, right? That's how you win over the real estate agent. But that's also how you help the client, because like I said, when we started this, most people disqualify themselves in their own head. Because they don't think that there's deals out there. They don't fully understand. They're not understanding that the cap rate isn't the same thing as the DSCR ratio. Yeah. These are ones you kind of have to look at a lot. I like to say whenever you get those clients, you call me and I'll explain it. It's super easy when you're actually looking at it. It's just for the first time, it's always a little confusing, right? But these are great loans because they're repeat customers. You get a lot of people who just make a good amount of money and they'll buy 1 or 2, 3 of these a year. And so they'll come back to you because you helped them before. It's always great. And I tell the agent, I've had so many investors switch agents constantly. And so I'd love to work with an agent who knows how to lock in a client. I'm hoping you're that person, right? That person's going to then think in their head, yeah, I am, and want to work with you, right? You're not just saying, hey, give me a deal. Do you like me? You're saying, hey, I know how to do this. I'm looking for someone who, and it's true. I mean, I've had investors call and they say, oh yeah, I mean, this is my first time using this agent, blah, blah, blah. But yeah. Anyone have any questions about those loans? You're going to have tons when you get the client. They're actually pretty straightforward. The main documents you need is you need the other weird nuance is it'll ask about short-term rental. Is it a short-term or long-term? When you hear short-term, they mean vacation rentals, not if someone's month to month. Most lenders are totally fine with that. They just want to know that it's when they call a long-term tenant, they mean a renter who's living there, if that makes sense to everyone. Oh yeah, any questions? They're great loans. Yes, people can qualify off their own income as well. So, I mean, most lenders you don't have to have a 1.25 ratio. So even if the property's not cash flowing, they just have to qualify with a little bit of their own income. Why would someone buy that? They're wanting to renovate a unit and up the rent. Let's say there's 5, it's an apartment complex, or there's 2 empty units. They're going to renovate it and they're going to rent them out for a lot more than it is cash flowing, but they want to buy it now. That is always an option as well.
Yeah. I don't know is your brokerage licensed in Michigan?
Not as of right now.
Oh, I was just thinking like a place like Detroit would have a ton of renovations because all the condemned houses and stuff. So I feel like that place specifically would probably be great for this.
Yeah, that's for, I mean, when you talk to people who are looking like they want that type of approach, there's not a lot who want that type of approach, which I love. Like our own mortgage company, for those of you who have read our brochure or whatever you want to call it, but we have a real estate investment. Well, it's getting finalized here soon, a real estate investment trust, and we focus on ones that need renovation. I like to talk to people about where the job market's at too. When it comes to commercial loans, there are some lenders that we have partnerships with. So when you go over, 5 units, usually around 6 plus, they become commercial business purpose loans where you can buy apartment complexes. Most states, Arizona, I think you can do it too. I think the only states like Hawaii, Alaska, New York. The rest we can do business in. So you can close loans without a license in that state because it's a commercial loan.
Oh, excellent. Okay.
Yeah. So, and I am working on Arizona for that. There was just a couple hoops I have to jump through. Right. Small things though. Yeah. And then the only thing I was going to share too for this meeting is, because we always like to talk about loan products that someone did recently. So the one I'm highlighting, I know before you guys, since you all were here early, I talked about Mary's deal. But I have a refinance right now. Quoted the guy. It was clear as day he should keep it conventional for a refinance, and he wanted a certain payment. He was willing to buy down the rate a ton. But I did not give him the second option of an FHA loan. And so his mom is a real estate agent, which I did know that. And he went and talked to friends and family. It still is fine. He's very loyal. And so I quoted him the same thing I'm giving him a killer deal. And so, but he of course said, well, hey, why am I not getting quoted FHA? This other lender is telling me I can get the same rate for no cost FHA. I'm like, yeah, no cost. You have upfront mortgage insurance. It's the same cost. But rates had jumped up since the last time we spoke. So I was like, well, you can't even get that rate anymore because it costs too much. And there is a limit of how much you can buy down the rate because they're going to say that it's a subprime loan, like we're screwing people over. There's reasons for that. And so I had to say, well, I mean, now the FHA loan is the best option because you chose to wait. But I'm not going to harp on that. Yeah, we can do the FHA. I just didn't think whatever. And so there's ways to sell it. So always, always, always give people two options, because if you don't, someone else will, and they're going to always pitch it in a weird way that you're like, well, that's not the best option for you, but I see what they're saying, I guess. You just don't want people to feel like, they didn't have an option, right? It's better when you give people two options and explain why one isn't, because when they talk to someone else, they're going to say in the back of their mind, yeah, you're really pushing this loan, but I remember Cameron, or I remember Brian, or whoever saying why that's not the best option. I have yet to hear you say that. So I feel like Brian's the smarter one, right? That's what's going to happen. That's what's happened to me is people, when I was an agent, people say, your lender that you referred, he explained these two loans. This other person was trying to push me onto this loan. And he explained that when they push that loan, it's because they're trying to get me to refinance 6 months from now. So I don't trust that other lender. And it works. So yeah, hopefully that's all helpful. Thank you all for joining.